Okay, our hosts this morning are Front Range Business. We have Suzanne and Dawn online, and I'm going to go ahead and turn it over to them. But before I do that, just a few housekeeping things. So during the presentation, we're going to meet for an hour. We'll have time at the end for Q&A, but if you have questions, in the meantime, please feel free to utilize the chat feature, and I'll be monitoring that and then interjecting with Suzanne as she's doing the presentation. So feel free to jump in with any questions, and then, like I said, at the end, we'll open it up for open Q&A, and you can just unmute yourself. Please keep your audio on mute during the presentation because it helps to cut down on background noise so we can all hear. And then the other thing is I would suggest using speaker view because you'll be able to see the slides better as opposed to gallery view. And if you're not familiar with that, it's in the upper right-hand corner. There's an option there, and you can just click it and see. So with that, Suzanne, I'm going to turn it over to you.
Okay. Even though we introduced ourselves, I'll do it again. I'm Suzanne DeLucia with Front Range Business, the local business brokerage firm. And I'd like to introduce Don Hubbs, my colleague as well.
Hello.
Okay, guys, let's move on. Yay, it's changing this time. So for those of you who have taken other Jeffco Business Resource Center workshops, we have one on how to buy and sell a business. And we'd like to do a small review on business valuation in general, and then go into COVID impact. So we're going to talk about what businesses were like before COVID showed up. Then we're going to talk about businesses during COVID. Then this question every seller has, are there buyers out there? And actually this should say, is there money out there? And then thoughts on recovery valuation. Okay. So when we are valuing a business, of course, we look at it on how it is in the owner's hands, but the buyer's not going to look at it that way. It's about the company's transferable value. Don, you're really good at verbalizing this, so maybe you'd like to put in a word or two here.
Well, I think, you're going to absolutely, evaluation is going to need to look at historical. What has the business done over the last 3 years? How much value has flowed to the seller as the seller ran that business? But when you're looking forward, you have to recognize that it may transfer differently. That could be some unique skill that the owner has. That may be some financial distinction that they have, whether it's the owner was paying less than market rent, or they had their family involved and paying different kinds of salaries, or with the departure of 2 owners, you need to bring in a paid employee to backfill some of that work. And of course, where's the market going? What's the future of the industry going to look like? All of those things are part of the calculation of transferable value.
Thank you. So we try to quantify it mathematically, and this is incredibly simple and incredibly not simple. The earnings of a business times some multiple is equal to the business value. That's how most businesses, small businesses we're talking about, are going to be valued. So first question, what are the earnings of a business? It's not the bottom line of your tax return, I can tell you that. So there are 2 very commonly used methods, and you may have heard of them. EBITDA, which I'll explain, and SDE. EBITDA tends to be used for larger businesses, professionally managed businesses, businesses that are selling to strategic acquirers or private equity groups. And your small owner-operated businesses tend to sell via SDE, seller's discretionary earnings. So this is EBITDA. The earnings, the net profit on your P&L or tax return before interest, because you may be paying interest or you may not be paying interest. A buyer will have a totally different debt structure than you, or no interest. So that could flow to their profit line. Taxes, certain businesses, C Corps, do pay taxes before their bottom line. We add that back. And the 2 non-cash expenses, nobody's ever written a check for depreciation or amortization, but if you look at your tax return, your accountant puts it in there. Depreciation is a write-off of the tangible assets of your business over time. And amortization is a write-off of the intangible assets. So if you paid a franchise fee, you may amortize that. If you bought a business and there's goodwill and a non-compete, you may amortize that. You may amortize patents and things like that. So we add these all together to get what the business is earning via EBITDA calculation. Then for a small business, they run their books totally differently. 10 different businesses will have 10 different set of books. So we try to compare apples to apples. So the SDE calculation is the EBITDA with one working owner salary, any discretionary expenses they might take out of the business, the health insurance, the life insurance, the car, the meals and entertainment, the business write-off on a trip to Italy, whatever. Normalized expenses, as Don indicated, sometimes if you own the building and you're going to lease it to your new tenant, there's going to be a different rent. We adjust that. One-time expenses. You had a lawsuit that you settled and had legal expense for that. The new owner won't. So we come up with a value and we look at a 3-year history, but we've got an earnings stream. And then there's a multiple that it's multiplied by. It's the risk quantifier, because every investment has a perceived level of risk and an expected rate of return. And in businesses, we always talk about what's the likelihood of future income, what's the replicability of income. So everybody remembers the rise and fall of video stores, Blockbuster. Well, they're gone, so we don't have many people wanting to buy video stores. The multiple would be pretty close to 0. Replicability, Michelangelo, here's the marble, here's the chisel, here's the hammer, you create the pietà. Very low replicability of income. That's what we look at. And here are a few things that influence the multiples. Don, do you want to just give a brief summary?
Yeah, I'm not going to, absolutely. Don't want to read the list because I think people can do it, but in talking to the list, understand that some businesses are more attractive. There is stability. For example, when you have contracts, long-term contracts, that's going to add stability into the business. When that likelihood of future income, if it's very difficult, for example, for competitors to enter it, that's going to affect the likelihood of future income. Whereas if there are no barriers to entry, then you have the possibility that even though you're in the market doing well now, all these additional competitors can enter. So as you look at this list, location, lease is going to matter. Do you have a facility, just to pick one, a facility that is capable of, if expansion is your goal, are you going to be able to do it in that facility, or is it already fully built out? All of those things are elements that get studied in putting the valuation together, and each one of them can move the needle in one direction or the other, some amount, so that the buyer will look at this and be able to say, okay, here's the positive elements of risk and value. These might be the negative elements of risk and value. And they're all part of that go forward look.
Thank you. Talk about moving the needle. We had a commercial cleaning business for sale a few years back. When we first met with the owner, no contracts, anything, and we gave him an estimate of what we thought we could sell it for. He said, that's not enough. We said, go get contracts. He said, my customers won't do it. Shockingly, he got customers from their contracts from 100% of his customers, and we sold the business for double what we originally told him. So it does matter. These things do matter. Anyway, moving on in this, here's the range of small business multiples for SDE earnings. They're typically 1 to 4. So if your earnings are 200,000 on a business, 200,000 would be the low end, 800,000 would be the high end, and usually they fall somewhere in between. Rule of thumb, smaller business, typically smaller multiple, larger business, larger multiple. Take all the businesses, put the comps together, they come in at 2.2 average, and the rules change for larger businesses and strategic acquirers. Sometimes they will be able to pay more, willing to pay more for a business because they can do things with it that they couldn't, somebody else couldn't, a standalone buyer. So here is just a simple example. We have SDE earnings of 400,000. We've determined that the multiple on this business is 2.5, so it's $1 million business, and that does not include working capital. When the seller takes their cash receivables, pays off their debt, pays off their payables, it's probably going to be a plus or minus, hopefully a plus. Sometimes we've seen it to be a very significant addition to their net tax proceeds. So that's enough on business valuation, historic business valuation. We've laid the foundation. Any questions on that? Okay, good. Okay, so along comes COVID. So we've spent a lot of time thinking about this, and we've decided that businesses are going to fall into 3 categories. Those that aren't affected by COVID. Some are even doing better. Liquor stores. Don't know how many of you have given more money to your local liquor store than previously, but restaurants and bars are shut down. When this is all said and done and normalcy, whatever that returns, we're actually going to have to tell liquor store owners that you got a bonus, a bump. But the store isn't going to be doing, most likely in the future, what it did during this COVID period. So we will decrease the sales and the profits on those businesses. There were businesses that were partially shut down during COVID. Buyers are going to value these cautiously, and what we call the rebound rate is critical. How fast can they come back to normal or a new normal? And then, unfortunately, those are those that shut down totally. Some can or will reopen, and we put this show together a couple weeks ago, and since then, there's been a lot of open up. Restaurants have been opening up, personal service businesses have been opening up. There's rules and regulations on those, and there's heightened level of caution with buyers. And then in the sad universe, there are some that are not going to survive. The Restaurant Association about 2 months ago said that 14% of restaurants would not reopen, and what we're hearing, it's likely to be a quarter or a third won't survive 6 months. So let's look at these one by one. So if you are one of the lucky business owners who has an essential business that wasn't impacted, businesses are going to be very desirable. The valuations will hold and maybe even improve with supply and demand. When we wrote this, we weren't sure about financing because those of you that are familiar with the PPP, it looked like the PPP was going to take all the Small Business Administration loan money, but that isn't the case. And we actually this week had our first business sale, and it had financing via the SBA. So yay. So it's kind of like nothing happened with these businesses.
Suzanne, just to kind of another example on SBA, we were talking, having closings. I have a business listing that I went to 8 lenders who had all previously indicated general interest, but they all wanted to look at it in the new COVID-19 world. And their responses came back, still interested, but have some new criteria and other things that they want to take into account.
Thank you. And Don, when we get to the businesses that were shut down and reopened, you also had some experiences with lenders with that business that I want to talk about.
You bet.
Okay, so those that were partially shut down, the valuation is going to depend on how fast the business can rebound and can it operate at full capacity. As we know, restaurants, well, that's next category, but I'm going to talk about that then. Financing will be on a case-by-case basis, subject to assumptions and scrutiny, higher level of scrutiny. Here is where it's really important to have great financials, have monthly financials, and compare it to the prior periods of last year. So you got to have January, February, March, April, May financials, and the same for last year. This is kind of new in small business financing and valuation, but pro forma projections, future projections are going to be needed. The SBA is going to be valuing off of those, which we've never had before. So really important to either get your accountant involved, have a good person, have every line item documented. Amira, does the Jeffco Business Resource Center have anybody that can provide some, help with this or these services?
Applying for funding, you mean, and the different?
No, doing pro forma projections.
Oh, absolutely. Yes, that's absolutely what we do. Yes.
Okay, so if you are in the situation that you might need that, please contact Amira and use it'll be worth it to spend the money on a good person that can give you quality financials.
Well, yeah, and our services are free to Jefferson County business owners.
Okay, well, fantastic. Better yet.
Yeah, it doesn't cost you anything. You've already paid for it because we're tax funded. So I'll send contact information in our follow-up email, and just so everybody knows, I'll be sending this a PDF of this PowerPoint, so you'll have something to refer to later, as well as the video recording from this class.
Okay. So the next thing, expect some deal structure creativity. We're going to talk about what that means, but unless you are willing to take a discounted price, it probably does not mean cash on the barrelhead. Everybody good? Okay, then there were those poor businesses that had to shut down, but the ones that can reopen. So to what extent can they reopen? Don, you and I are working on a service retail combo business that has been able to reopen. And boy, 3 months ago, that business slam dunk, great books, great business, would have gotten great SBA financing. What are your thoughts and what do you want to share on that?
Well, again, I think the question that everybody's asking, that there's a recognition that, there's going to be a trend line, there's some trajectory for the COVID-19 circumstances we're all living under. There's going to be a reopening of the economy. There always has been. And it's going to be tied, an individual business is going to be tied less to the regulations of closure and more to people's acceptance of going back and participating in that business again. So getting to grocery stores is going to be pretty obvious, getting to liquor stores. But what about personal services business? Are people going to go to get their hair cut as often or in the same way, or a salon? And the more discretionary the choice of going for those personal services, the more concern there is that it will build back more slowly.
And then there's regulation on those. In this particular business, they're allowed to have 10 people in the facility at any one time. And since it's one-on-one service providers, that means 4 to 5 clients at a time. And so the business is operating at about 1/3 of what it did. And hopefully that's only temporary, but, well, it will be only temporary, but in the short run, it makes the business sale more of a challenge. And
Yes, because those are the numbers. The previous numbers are easy to understand. The current numbers are easy to understand. And the question that nobody really has a strong answer on is, when do you get from the current numbers back to the previous historic numbers? How long will that take? What is the cost of getting there? And who's going to bear that cost? The seller or the buyer or some combination?
And this business, particular business, I'm using it just because it's a top of mind example, but great business, a lot of customer loyalty. They believe that they will be the survivor. They believe that some of their competitors will not. We believe that too, actually. So we've just got to figure out a way to help them. So again, expect creative deal structures or distressed prices. If you want out now and you want out now at a cash price, expect to take a pretty significant hit. How long is it going to take to get back to the previous values? We don't know. Our question to the sellers is the time or the money more important to you? If you can wait it out, maybe you should. If you want out now, okay, let's figure out how. And most importantly, do you have the working capital to make keep your business afloat until things do improve? Okay. Then there's the totally shut down and not reopening group. I talked to a coffee shop recently that was barely surviving before COVID. I'm not optimistic about their survival. So liquidation of the tangible and maybe some intangible assets. So restaurants are a great example here. And Don, you've worked a lot in restaurants.
Yes, and just a specific example, I've got an owner of 2 restaurants. One is going to reopen successfully, and it has had strong carryout and other delivery kind of business associated with it, while the other one is more dependent on customers coming in and sitting down and enjoying that dining experience inside the restaurant. They have had to fully close because they've not been able to make that restaurant operate. And they're at a place where they're taking a careful look at whether it makes sense to reopen or just leave it closed, sell off the assets. One of the issues for them is that they do have another 10 months. They have a landlord who's not giving them any satisfaction in the form of relief. So it's a very, very costly proposition for them to not reopen, but it may still be better than reopening. Difficult.
And they don't have a cheap lease.
They do not have a cheap lease.
No. And so that goes to the lease. What's the status of your lease? Have you personally guaranteed it? Most small business leases are personally guaranteed. Can you get out of it, or can you get someone else to take it over? It may behoove a restaurant owner to get out of the contingent liability of the lease, to hand the keys over to somebody and they get a fresh start.
Suzanne, just add on this one. We look at this, talk a little bit about the landlord. We've participated in a number of industry roundtable gatherings where we're sharing information about brokerage and landlords and other things. And all of the effort is to communicate with landlords that, your long-term interests may be better served by being flexible in this environment. And a number of the landlords are indeed coming to the table and saying, how can I help you? I want you to reopen. You've been a great tenant. How can we share in the burden of what we're doing here? There are some landlords who are taking a very short-term approach. It's unfortunate, and that may be their undoing for that property, because if a business can't reopen, And if the market doesn't attract new companies to come into that space, they could be looking at significant vacancies.
Right. And back to restaurants. Restaurants are incredibly expensive to open. The build out, which is about 2/3 of the cost of opening, can be $200 a square foot or more. There's a value to that intact restaurant. Anyway, if you're in this situation, get your lease out, go over it with your attorney, talk over your options, and in a number of cases, this may be bankruptcy for a number of people. Sorry to say. Okay, so where do we start on valuing businesses? So after a lot of thought, we decided, okay, the seller should get the chance at getting their pre-COVID value. That's why we went through the exercise of showing you what that was. And that's with the huge assumption that they can hang in there. When we've got the prices equal to earnings times multiple, we've decided that the multiple should prevail. It's the earnings that are most likely to change. So,
and we're Suzanne, not only have we decided, we're actually seeing that. We're seeing that with lenders. We're seeing that with deals that are moving forward. It's not an arbitrary call. The market is really saying multiples are not going to be moving much. What will be moving is that calculation of the potential earnings.
Yeah, and through the dark months of March and April and early May, we didn't have this feedback. We're just finally getting it from the market. So will the earnings hold? Can the business rebound to justify the pre-COVID value? We're hoping that businesses will get there in a year or two, and we're trying to create deal structures that allow that it's a win-win for the buyer and the seller, that allow the buyer to get in there and be able to run the business, and the seller to have a chance to recoup the value, assuming the business does come back. So how do we do that? So we look at how we finance any business purchase. It's a three-legged stool. Usually there's cash from the buyer. In a huge percentage of deals, we had bank financing, which was almost always the SBA, Small Business Administration financing, the 7A lending program. And then in a huge percentage of deals, there was seller financing. Even if there was a bank loan, the SBA and the buyer both felt better if the seller contributed a small amount. Kind of a pre-COVID bank deal was 10 to 20% down in cash from the buyer, 70 to 80% from the bank, and 10 to 20% from the seller. Everybody good? Move on. So part of the dark days of COVID was we didn't know where the banks were. They got very involved in the PPP program, and all of our lenders were pulled off of that, and nobody knew if there was going to be money. They were actually potentially pulling the 7A SBA lending program money and putting it into the PPP. And this 7A is a very valuable, important part of the small business economy. The good news is there's still over $100 billion in the PPP coffers. So the SBA lending program is safe for the time being. As we said, the lenders are starting to work off projections. Never have done that before. Higher levels of scrutiny on the business, for sure, as Don indicated, and higher levels of scrutiny on the buyer. Direct, relevant experience is important. Well, not direct, sorry, relevant. So it used to be, if you would eat in an Italian restaurant, you could almost buy one. But now if you've got to prove you've got the skill sets. It's an interview. So if there are 20 employees at this business, you need to have had managed a business that had a significant staff. The other difference is cash reserves. as things got looser with lending, you could put 10% down and they'd count on the cash flow of the business bridging the gap. They'd lend you working capital. Now the lenders want to see, I think they're going to be coming up with higher down payment requirements, and they want to see 10% cash reserve to make sure you've got some ability to ride the waves. So what was 10 to 20% down is now probably 20 to 30% the buyer needs to have.
Suzanne, I just want to add that this is super important information. What's up on the screen here, probably one of the most relevant to buyers who want to actually acquire a business, and to sellers to recognize what the market is. And how do we know this? Well, one of the things that we do as brokers, and not everyone realizes this early on, although you come to as you work with us, brokers have to take any business they want to list, and they have to get in front of the SBA lenders prior to buyers really even coming to the table. So these businesses have been out and have been vetted. And then the lenders give us their responses. What's it going to take to make this transaction happen? And all of these things that you see on the screen are exactly what we are directly hearing from lenders on the businesses we're looking at listing right now. So we know that this is going to apply for buyers, and sellers should be aware of it's not as free of a market as it was 3 to 6 months ago.
Thank you. So, in the positive, direction, there's some really great programs in place if your business can qualify for an SBA loan. One of the biggest ones is if you can close by September 27th, 2020 and be funded, there is a 6-month payment holiday. That is like getting 5% off of your loan if you're amortizing it 10 years. So if, maybe 4% off the price.
And it comes at the time that's most important, because it's the first 6 months when you're really trying to develop cash flow and understand the management of the business. It's a really nice soft entry.
They are talking about increasing the bank guarantees up to 90%, which will make the lenders more excited about lending. That's not in place yet. I'm going to say financing will never be cheaper. Was it you, Don, that got a 3.65% fixed term on a
Fixed 10-year? Fixed 10-year.
Never have seen that, ever.
And that was with that was a 75% of price loan.
Okay. But again, borrowers are going to be subject to much more stringent qualifications, so fewer businesses will qualify. Okay. So fewer cash sales are likely. Going to that service retail business we were talking about, because they're only operating at a 3rd level, somebody might buy it for cash, but it probably won't be at the pre-COVID price. Fewer businesses qualify. So where does the money come from? It either means it comes from the buyer or the seller. It's probably going to be the seller in a lot of cases. So we want to talk about some ways you might want to bridge that gap. So promissory notes, going to talk about those. Earnouts, adjustable seller notes, accounts receivable and payable assumptions, and debt and lease assumptions. These are some tools you have. So for those of you that are not familiar with a promissory note, it's a loan from the seller to the buyer. The amount, terms, condition, collateral, and recourse are all defined in the note. In small business sales, most of these notes are personally guaranteed by the borrower, and quite often the borrower's partner or spouse. If we're selling a business to Kroger, nobody's going to personally guarantee it. But if you're selling it to somebody who's in the job, lost their job, they're going to have to personally guarantee it. And they may even have to put up outside collateral. Most of the businesses we were working with, we were usually ending up with 80%, 90% cash to the seller at closing. So it wasn't so important. But we think we're going to see deals that are going to be half or a third cash down. And so a lot more risk to the seller. And if you get an SBA loan, they do require outside collateral if you have it. They'll require you to put up your house if there's enough equity in it. We may see this come into play in small business sales. Earnouts. Okay, this is an interesting concept. All or part of the business price is determined by the future sales, gross profit, or net income. So it is like, let's say the business is doing $1 million in sales, and the parties agree on an earnout of 10% of the sales of the business for the next 3 years. So if the business were doing $1 million and it was a 10% earnout factor, that'd be $100,000 a year for 3 years. However, if the business only did $600,000 this year, they would only pay $60,000 on it. We strongly encourage you not to do this on the net income, do it on the sales or gross profit. It's really hard to manage it on net income because that's manipulable. The maximum price can be capped or it can have no limits. So a number of years ago, I had a business for sale and it was worth a certain amount of money and got multiple offers, and all the offers said the same thing. So the seller said, this isn't going to work for me. What do I do? So I said, well, we got to make the business more valuable. So the seller went out and drummed up 17 new accounts. We knew that some money was going to come from these accounts. We didn't know how much. And so we did an earnout wherein the buyer paid fair price for the business as it was, but paid an earnout on the income coming from these 17 accounts for some period of time. The seller is rewarded for taking a risk, unless it's capped, but it's a way to bridge the gap. As a note, the SBA will not allow an earnout, okay? So you can't have that as a deal structure if you're going to be doing an SBA loan. But as always, there's a back door. So those are adjustable seller notes. So these are coming into vogue. There's 4 terms for them because nobody's come up with the definitive lingo yet. Forgivable promissory note, earn down, clawback note, or reduction note. You may hear any of those terms. And again, it can be the total price or part of the price. But what happens here is buyer only pays on the note depending on future revenues or other metrics that are defined. So in that business that was doing $1 million, if they only do $600,000, the note payments for that year would be lower. And then the next year they do the $1 million, so the payments would go up. There are SBA lenders that are accepting these, not all of them.
Yeah, Suzanne, we're
Yes.
just an example. We're structuring a deal now on a construction business. It's considered an essential business, so it continues to operate. But because of some staffing things and because of just some decisions by the seller, it's maybe slightly lower than it was the previous year. What we've done is on the seller note, we've created kind of a 3-tier scenario of revenues for the 12 months following closing over 5 12-month periods, literally over 5 full years. And at those tiers, if the revenue targets are not hit, then there is a significant reduction of the amount of the seller note that needs to be repaid. And so this is a $280,000 note. So if he collects the full amount of the note with interest over the 5 years, he'll get $332,000. If he doesn't ever collect a dime on it, it'll be 0. So the seller is taking that risk risk of 0 to 332,000.
One of the things I'm also seeing is because this year is the crazy year, sometimes the note payments aren't starting for a full year out, or maybe just interest or something. Okay. AR and AP assumptions. When we value small businesses via the SDE earnings method, we don't usually include the working capital, and the lender usually works with our buyer to make sure they have a line of credit or access to working capital. But in this case, the buyer would take possession of the accounts receivable as a financing mechanism. So the price would be increased, and they could also assume the liabilities of the accounts payable. And I'm going to say that this is with or without creditor approval. You probably will not get all the creditors to approve it, and a business can have 200 creditors. That would be impossible. You better talk to your attorney if you're going to do this. This is a desperate times, calls for desperate measures. There's one more way to do it, and then I'm going to tell you about a deal I did last year that employed all of these mechanisms. Assumption of debt or leases. So this is where the buyer would assume some of the seller's obligations if they have a loan, line of credit, equipment leases out there. And again, it's with or without lender approval, and you better talk to your attorney. And if you're the seller in doing this, you may not be released from liability on these notes, but is it better to have somebody else at least trying to pay them off, or you being stuck with it and filing bankruptcy? You've got to decide. So last year, I had a service business for sale, and the guy really wanted his employee to buy it, and the guy really wanted out fast. And the employee had $10,000, and this was a $300,000 business. So A, no lender's gonna finance this. B, the guy didn't have any money. Even if he gave the $10,000 to the seller, he had no working capital. So they had agreed to this $300,000 price. So the business had $100,000 in accounts receivable. So we tacked that on. So all of a sudden the $300,000 business price became $400,000. This business was leasing 3 very large pieces of equipment. So let's say those equipment leases were $150,000. Well, the business was paying these leases anyway, so the buyer picked that up. So it took the seller note down $150,000, but in this case, the seller was still liable on these leases. They had agreed upon a defined term of the promissory note for so many years at such an interest rate. We had to add 3 years to the business note term to make sure that the buyer's payments would allow him to be able to pay himself, pay the note payments, and have a fudge factor in there in case things changed. So the only element this did not have was the clawback or earn down, because the business was stable and we didn't know what COVID was at the time. Everybody good on that? Okay. Are there buyers out there? Yes. That's all we have to say. No. We're getting incredible buyer inquiry, and we're going to talk about why. But we're getting probably twice the buyer inquiry that we got pre-COVID. Do you think that's true, Don?
Yes, substantial number of buyers. And again, as you say, you have the reasons why, but no question about it.
Okay, so let's see what that means. Thoughts on valuation recovery. This is a buyer's time of opportunity, except for the top tier businesses, those essential businesses. It's a buyer's market. There's some screaming deals, and there's going to be screaming deals. A lot of buyers out there, including bottom feeders. We've seen a few of those. But the deal structure is going to have to reflect the economy, the economic risk, and the seller or the seller's desperation. So here are our buyers' concerns. They're scared and they want the deal structure to reflect their risk. So for perspective, I was in this business on September 11th. When the planes hit the buildings, we lost 5 deals. I was selling a quick lube, and the buyer that we had in line called me and said, I was trying to sell him an obsolete technology. And I said, do you mean the internal combustion engine? And he said, yes. We didn't get to the closing table with that guy. So anyway, unemployment is going to be high, and there are going to be people that need to buy jobs. Last year, we had a really nice carpet cleaning business for sale, and it earned a lot of money, but it was just plain and simple unsexy. Unsexy is going to become more sexy, I think. Pardon me? Somebody say something? Okay.
There's a, Suzanne, as a description, there's a category of buyers, if you will, we call them the corporate refugees. And anytime there's an economic move like there is right now, there are folks who are no longer going to be moving forward in their corporate world. They're well-trained, they're experienced, there could be great managers, and they're looking for an alternative place to operate. And they think it may be time to take those talents and get out into the market and buy businesses. And that's a percentage of the people we're seeing now are these formerly corporate people or people ready to leave that volatile market and tap into something they think they can better control.
Carpets are going to get dirty from now till the cows come home. It's Amazon proof. Amazon isn't going to come and clean your carpet. It's Corona proof. It's still going to, it might get dirty. Your home carpets are going to get dirtier because you're at home more. That business became sexier. This is a great time for existing businesses to buy either a competitor or a complementary business and add it into theirs. Maybe reduce some expenses, find some synergies, expand into new markets, new customers, new geographies. Now, these acquirers really only place value on what they can't replicate on their own. If you just have a business that's a customer list, they're either going to have a real creative deal structure, or else they'll just put a salesperson out and drum up that business themselves. Another thing we think is that buyers are either going to have less cash. Obviously, a lot of them, their stock market portfolios are down, or they're not going to be willing to spend as much cash, even if they have it. There's going to be a hoard cash mentality. So wrapping up, if you're a seller, you need to understand your value proposition in order to effectively sell or exit your business in this unprecedented time. Get professional advice. You know, selling your business is one option. It's keep it, shut it down, sell it, try to get somebody else to manage it, but it's a time of change, and change is always opportunity. So this isn't our first rodeo. We've been through this. Dot bomb, September 11th, recession, on a local level, the floods. We've always come back. We'll find our way to a new normal. The laws of physics and business valuation will prevail. And we'd love to talk to you about your unique situation. If you'd like to call us, the contact information will be on the slide deck Amira sends out. It's time for questions.
Okay, that was excellent. Thank you so much. And let's see. Okay, thanks, Francisco. Watch for the follow-up email. He's just logging off. So if you have questions, please feel free to just unmute yourself and chime in.
Hi, this is Cinnamon Trimmer. Can you hear me?
Yes, we can. Thank you.
Hey,
Thank
Cinnamon.
you. Hi, I actually am an SBA lender, and I really enjoyed this very much. Thank you for putting this together. I did want to make one small comment about the 6-month holiday that was mentioned. That must be funded by 9/27. That is true. However, it has to be fully funded by 9/27. So if there is any construction in the SBA transaction, that will not qualify for that 6-month holiday.
Don't have your closing date on September 27th. Try to do it before. Is that what we're hearing?
Yes, and have all your construction in a separate loan.
Okay.
And Cinnamon, that's a great comment. And the other thing for people to understand, while September 27 might seem to be 3.5 months away, and Cinnamon, you can maybe be more specific about this, but we are telling people allow at least 2 full months for the SBA to work its magic and get that loan through, which means deals have to be put together in the next 45 days.
I met
Yes.
Cinnamon through the PPP process, and I think she's great, everybody.
Well, thank you. Yes, absolutely. I mean, time is of the essence. If you want to take advantage of that opportunity, my recommendation is, get those 3 years tax returns. We are not doing 16, 17, and 18. We are doing, 17, 18, and 19. So you need to have your 2019 taxes together and, get that information gathered. The SBA does require a lot of documentation, as we both know, and that will require about 2.5 hours really of solid work on getting that SBA piece done. I love the fact that Jeffco can help with the projections, because that is an awesome piece. A lot of people start to freak out about that, but I would definitely say you need within the next 30 days, if you are anticipating putting together a contract for a property and business, you better get it done now.
Thank you so much. That's awesome. And thank you for joining us. I just sent you a chat because I'd love to connect later.
Thank you.
Yeah, that's great. Okay, any other questions? Okay,
Well,
going once.
Do you guys have sources for like multiples on different business types that are kind of the standard going rates to give a good indication of a carpet cleaning business trades at a 3-time versus a liquor store that trades at a 4-time kind of thing?
Absolutely. We'd be more than happy to provide that for you.
we
Awesome.
subscribe to databases that collect the data, Carl. So
Okay, sweet. Yeah, that'll be helpful.
All right,
It's never going to be quite as exact as that, but it's going to show you ranges, I think.
Yeah.
Perfect. Any other questions? Okay, well, thank you so much for coming today.